Welcome to the Monocle Banking Podcast, curated by Monocle Solutions. This week, we sit down and get stuck into the balance sheet issues that have turned around Cell C. Well, Cell C has had more near-death experiences than most companies get annual reports. For years, it was the perennial third-player telco story: heavy debt, bruising competition, network investment demands, and repeated recapitalizations, as well as a shareholder structure that at times required something like a tax advisor and a stiff drink to understand. But now, Cell C is asking the market to see something completely different. It's a newly listed, deleveraged, capital-light mobile operator with a much cleaner balance sheet, a virtualized network model, a growing MVNO platform, and a CEO who says the turnaround is no longer just a promise, but really is now a platform for growth. And the question, of course, is whether this really is a genuine structural reset or simply the latest chapter in South African Telecoms' most persistent comeback story. So Jorge Mendes, CEO of Cell C, who joins us now, welcome. You've had a big job to try and convince the market that this time is different. Let's just start with the cleanest version of the pitch. If an investor last looked at Cell C 5 or 10 years ago and they concluded too much debt, too much complexity, not enough scale, what specifically is different today?
Yeah, thank you, Michael. Thank you for having me. So pretty much all of what you say is different today, and you're quite right. I think it's been super complicated. To keep this business alive has been a multitude of complex recapitalizations, largely led by the then main shareholder, Blue Label, to keep this business alive. The business is a 25-year-old business, so most do not survive having gone through what Cell C has gone through. So what is different today? We listed on the JSE on the 27th of November last year. We're now a fundamentally different business. So we are a licensed, asset-light, modern network operator, and we're very clear on that. We hold spectrum. We control our own core network. We carry all the responsibilities of a licensed full mobile network operator. And effectively, we're saying that we need to ensure that today's way of challenging the market is effectively one that does not protect infrastructure ownership, but rather structural changes that bring down the price to communicate. So we've positioned ourselves in a sense that says, well, in 2005 or perhaps even before that, owning infrastructure could have been very much the right question. Now it's, how do we bring prices down and how do we improve the cost of connectivity? So effectively affordability. And we believe we've positioned ourselves now in that space with a roadmap that has to ensure sustainability. We cannot ever again go backwards and create doubt in the way that we structure. So we think we've done that and done that properly with a very lean, simple structure, but one that requires absolute dedication to execution.
And George, because you're in a closed period, I don't want to ask you for current trading color or any numbers that the market doesn't already have. But structurally, when investors look at Cell C now, I was reading the Alan Gray thesis, which seems to, backing up on what you said, that the old complexity has been stripped away, that Cell C is now much more investable as a capital-light platform business. So it's not about owning the towers. Is that the simplest way to think about the new Cell C, or does that still maybe understate the operating complexity inside the business?
No, I think that's the right way to look at it. Of course, nothing is as simple on the surface, or rather, simple on the surface and got detailed in the background. But I think that's the nature of the sector. If I give the analogy as an example, when you work on your smart device, it's quite intuitive, it's user-friendly, it removes the friction of making a user really enjoy the experience. What happens in the background is very complex, right? There's a whole bunch of algorithms running and checks and balances to see whether you have credit in your wallet, are you a valid licensed, authorized subscriber, prepaid, postpaid, mobile originating, terminating, what URLs you're searching, etc. It's a lot of complexity in the background. That's technology. Cell C is very much that way. So how do we remove all this complexity? Surely bringing the cost to serve down is a lot more inclusive model as opposed to ownership of infrastructure. And we're seeing this. This is not new, by the way. We're thinking this is telco of the future. You're seeing it in markets like Spain, Japan, Germany, certain markets in Africa, France, where sharing of infrastructure, and even go further down the value chain. If you look at a pooling and sharing of spectrum as an example, it's use it or share it philosophies that are starting to come through from a regulator point of view, because that effectively brings down the costs to produce connectivity, and therefore brings prices down and creates an inclusion from a technological economic point of view. So we do think that, clearly you have to look at the metrics from an investor point of view. We have a fundamentally deleveraged balance sheet, so that's clean. Now we only have trading debt. We have a model that says we're very asset light, and so our capex numbers, which is in the public space, is circa 800 million compared to, if you look at the next competitor, probably even in a low year, it's somewhere around 6-7 billion, and perhaps in a higher year, it's somewhere around 10 billion. We are 900 people versus perhaps 4,500 as the next competitor. So you can see that our P&L is fundamentally different. And we structured in a partnership way where we believe that partnering very deeply, which is fundamentally a core and ethos to our operating model, we think we can get those market segments through the partnerships in a much more efficient way than we can if we had to create sub-brands ourselves and go after those directly.
And I think it's in those partnerships where often you find debates on FinTwit and other platforms where a lot of the critics will say, no, you're too dependent on your partners. So obviously a capital light model improves your return on capital. But how do you think about the trade-off between lower capex intensity and strategic control, and that critique that, oh no, you're now dependent on other partners who control the infrastructure, or in the MVNO sense, control the consumer?
Yeah, I think it's an important part, right? Because it is different. And I think that's I say, when you go down these models, they're not unique in the world, but we certainly are the first in South Africa. And we firmly believe that, we are a fully licensed operator. So we have all the obligations of an operator. What we've given up is a steel structure, and we've given up a physical radio panel. We effectively do partnerships through a virtual radio panel. Otherwise, we have everything that a network operator's got. And then, without putting it too simply and too crudely, I think if you accumulate towers with physical steel structures, surely that can't make you a fundamentally better operator, and hence why tower cos exist, which today, if you look at this market, even my yellow colleagues don't fully own the towers until this acquisition now of IHS. Telkom are very much in the same space with a portion of the towers sold out. Vodacom very much considering it. So I think infrastructure sharing is very much going to happen. It's not if it will happen, it's how quickly it accelerates in this context. And then effectively, if you look at the partnership model, so we could choose to go and do something directly in terms of consumers and create a brand. But if you look at the partners, and this is not an exhaustive list, but, Capitec, FNB, Standard Bank, Mr. Price, ShopRite, they're all very reputable brands that have partnered with us, and we have partnered very deeply with them to unlock each other's strengths to either make us a better telco or them a better bank or retailer. And we think that's a lot more palatable to the way that the business is going to be conducted going forward. You just do different revenue share models, you do different commercial constructs. But I believe, if we think that a red, yellow, or blue prepaid subscriber has got more protection than an MVNO subscriber, I think we are heavily misleading the market in that sense. A prepaid subscriber can churn at any stage. A postpaid contract directly with any one of my competitors, including the Cell C brand as well, could easily terminate and move. So it's about having the most compelling propositions with the biggest ecosystem, and I say biggest in terms of value add to the subscriber.
Value add to the subscriber, I think, is probably the next frontier of where we're really going to see the competition needle move next. Just the MVNO and wholesale story is compelling. But talk to me about where the economics sit, because some might say it's just a middleman economic story. So what is Cell C's enduring economic role between the infrastructure owners and the customer-facing banks and retailers and brands?
Yeah, it's a great point. And I think, what we've done is we've said the cost to produce is X if I use it for my own brand. So if you take the Cell C brand directly, we add costs like distribution, marketing, go-to-market, commissions, SIM card production, etc. And you get to a contribution margin of X. If you sell that traffic to voice data, SMS, USSD, etc., to a wholesale provider, an MVNO, they effectively have largely those costs sunk in their business. That's why the partners we have selected and that they've selected in choosing us fully embrace this, which means to have a higher probability of success as an MVNO, you need a large subscriber base, you need physical distribution, you need digital distribution, preferably the combination of both, and you need a high utility product. So banking, electricity, voice, data, etc. And if you have those ingredients, then largely all the costs that I've mentioned earlier in carrying it in the Cell C brand disappear. So you have a like-for-like contribution margin by doing it via partner MVNO or via doing it directly with retail. And given our P&L shape that I explained earlier, so 800 million capex, 900 staff, I've swapped capex for opex, and therefore I've got quite a significant amount of predictability. It allows us to go and bring prices down, but it's not so much about bringing prices down to be the cheapest. And in fact, we are not. We provide great value in the way we go to market in the journey. So if you look at partners, they don't have to go and incur additional costs. They already have all these branches, digital apps with customers engaging all the time, and it's simply inserting that proposition into a journey that makes it very cost effective and really, really palatable at the time that the customer needs that service.
You've said previously that the larger operators might not want to lean too aggressively into MVNOs because they risk cannibalizing their own retail revenue. And right now, that's good for you. But is that protection structural, or is it just a function of where the market is today? Given what you've just mentioned about many of the competitors in your space also seeing that we're moving to infrastructure sharing, are they going to come for the MVNO market next?
Well, they could. And I mean, it's a choice. In fact, it's been mandated by the regulation to have one MVNO to be successful for a period of 3 years in the last round of spectrum. So we expect that that happens. I can assure you it's not for a lack of wanting the MVNOs. In other words, they haven't simply said, well, we'll let you go and get it and we'll just keep to our knitting. I think MTN have more MVNOs than we have in terms of number of MVNOs. I stand to be corrected, but they are very aggressively playing in that space. Vodacom has made a decision to enter. Telkom are still on the verge of doing so. But I do believe it's structural. I think you have to get to a position. I just believe that we're leading in that perspective from a South African point of view. I do believe that it's just inevitable that the red and yellow colleagues would have to do a form of infrastructure sharing, which then would mean that they'll have to restructure their business to play in that space. Because today, about 90% of the MVNO customers come from the larger players. 10% leave us and go to MVNO. And like I said, because of the contribution margin being largely the same, we're quite comfortable with that. So understand that the larger players would have a defensive strategy, which I could understand given their market share. But I do believe that it's a defensive strategy on the old way of conducting a telco business as opposed to the modern way of conducting a telco business. So coverage and building infrastructure was clearly the right question in 2000 and 1994.
Yeah.
It's definitely not the right question now. In 2026, it has to be the affordability has got to be the right answer to this rather than coverage.
And when you look at your numbers, the disclosed interim numbers show wholesale revenue up 22.5% and your MVNO HLR subscribers above 5 million. And without commenting on current trading, what would you say are the long-term drivers of wholesale economics? Is it just deeper penetration inside your existing partners? You've got some fantastic partners, Capitec, or is it higher usage, better monetization per line? How are you thinking about the wholesale economic drivers from here?
It's a great question. I think it's a combination of there's a few MVNOs that are only at their infancy. So you talk about new MVNO partners that are only getting going, and they're niche pockets. Some have got some large subscriber bases and so on. But it's also a combination of the existing partners that we have fully leveraging the capability. So at the moment, we're only touching a very small portion and it's growing quite nicely. But there's a lot that you can do in the ecosystem with all of our capability and all of the banking capability, all retailers' capability to unlock further benefits. So it's a combination of getting more subscribers, going up the value chain from an ARPU point of view. I mean, I don't think it will come as a surprise that, we have more than 100% SIM card penetration. In fact, it's nearly 200%. So one human being holds more than a SIM card. I think this is exactly the same. Is initially you might get some skepticism that says, fine, let me not give up what I have with my current MNO, but let me try out this MVNO SIM card. So it becomes a second or third SIM card. But I do believe that in time, when we start consolidating these benefits, you will equally consolidate the spend on the SIM card, and it becomes less about the SIM card and more about the human being behind it, which is most likely not going to throw away their banking relationship before they throw away their prepaid SIM card. So we think it's a combination of both. There's some new partners and then going up the value chain on different product sets and so on with existing partners.
And on prepaid, your disclosed numbers showed subscriber recovery, but obviously modest revenue growth. You've spoken about the unwinding of historically high airtime discounts as well. How important is that normalization to the investment case? And when investors look at prepaid, what should they focus on more? Is it the top line margin? Is it the ARPU or your customer lifetime value?
It's a great question. And I mean, it is fundamentally different. And it's a very important part. Given the two recaps that we've done before, a large amount of those recaps were funded through very sophisticated models in airtime. And so those airtimes came at high discounts because we never had trading relationship directly with banks as a result of our financial position. So that's fundamentally different. And we're starting to see that come through nicely. So what we reported was from a net growth point of view, which is of course net of discount. So that will continue to improve as we've guided. But you'll have to look at the combination of those metrics: subscriber growth, obviously, ARPU, and then obviously the subscriber number by the ARPU will give you the revenue, and then how efficiently you carry that. So, if you keep your costs down, typically the market is somewhere around 4% on airtime discounts plus payment terms, some up to 90 days, etc. So if you look at time value of money, let's go with the 0.8 or 0.9% per month. So you could see that it's somewhere around 6.5. We had some of these up to 40% in the way that we were structured before. So that's a fundamental difference.
It really is. And on postpaid, the disclosed story was revenue growth despite subscriber decline, with ARPUs improving as the lower value customers exited. And that's kind of, you want better quality business. Are you now saying that you are effectively rebuilding as a higher quality, more disciplined book rather than just a volume at any cost business when it comes to postpaid?
Yeah, absolutely. I mean, that is exactly the messaging. What you'd not like is very simple models, which is if you open the credit vetting tabs, you get a lot more subscribers, but you just spit out bad debt down the line. You need a very fine balance. And I think in today's day and age, there's a lot of information that you have that you can use more effectively. So this one is tightening up on credit worthiness, but two is looking at which products. And we have some really refreshing ideas, and we've started now. We're really at the infancy. So I think this will be a 18 to 24 month kind of program where you'll see incremental improvements. But you need to improve the vetting, both on credit worthy and cash worthiness. We've had some system restrictions as well. We've awarded an RFP. We've done the prepaid billing system, completed, I think, in September of the previous year, and that was done on time and within budget. We're now busy with the postpaid billing system, so we've got a lot more capability in making sure that there's flexibility on, taking deposits, different term dates, and those kind of things. But equally looking at cash-worthy customers that perhaps are not credit-worthy by sharing some of the banking information and see how we can structure certain products. So we've revamped tariff plans. We're looking at systems. We're looking at vetting. We've looked at our distribution channels. We've renovated just under 80. I think we're on 78 stores that have now been fully revamped with a new look and feel, giving consumers a better experience. We've got some new distribution channels. So it's a combination of all of these where we really are trying to get a great customer experience, but also mitigating for risk in some interesting new ways because you have a lot of that data. And looking for quality. I think it doesn't serve any purpose to sign up a large volume of customers that all equally go into bad debt.
The CEC acquisition is clearly important because handset financing and channel control, I think, matter deeply when it comes to postpaid. Strategically, what did you need to bring back into the group that you couldn't properly optimize before? And you've also suggested before that banks may ultimately be better placed than telcos to finance handsets. Does that mean Cell C's long-term postpaid model may look quite different from the traditional telco subsidy model?
Yeah, I think it definitely will. We'll have components of the current model, but we'll certainly be transitioning into different models. We have some very fresh ideas, which I think would land very well in giving customers what they want and actually improving their affordability. But I think to your first point to the question is, C was effectively kind of a finance house, if you like, handset financing. And unfortunately, postpaid business is more than that. So you need a go-to-market strategy, you need products and propositions, you need distribution channels. And CEC and the Cell C relationship happened by default as a function of Cell C's financial position. And it was kind of a loan between the two entities and that first right on the revenue associated with a postpaid book, etc. And that's how we landed up in that situation. So kind of a natural evolution that it would come back. Of course, we'd have to acquire, which we've done, and run the full end-to-end postpaid business that you can integrate much more efficiently. And we believe, for example, we would have the costs for running the retail stores, but the revenue would sit with CEC because of that structure. we would have, for example, the cost of running the billing system, but the revenue would sit there. So when you put the two entities together, you clearly unlock a much healthier business.
Yeah, no, absolutely. And just as we're reaching the end of our time, George, sadly, obviously the market, because Celsey has been through recapitalizations before, is going to be in a kind of stage of show me, not tell me. The SENS also makes the point that some pro forma information wasn't reviewed by the external auditor. So in a newly listed business with a complex history, how important is building credibility through clean, repeatable disclosure over the next few reporting cycles?
That's absolutely important. I mean, I couldn't agree more. I think one of the things, if we take it on the chin, we have to own is that, the Celsey story has been fraught with credibility, and it's been one of our key objectives to improve stakeholder engagement. This new management team has worked as if we're a listed company for the past 3 years. We've come from listed environments, so we understand the value of good governance and ethical business. So that's critically important. We see that improving all the time. We've already seen, they call it the thick trust index through Global Scam. We've improved a lot, and we continue to improve. And we have an ambition to be the number one most reputable organization. And that's a tall order, because you need the proof to be in the pudding, so to speak, as you say, results after results, and actually deliver on what we say. So we'd like to say a bit less and deliver a little bit more, and consistently. And we think that's critically important. And that will bring the credibility back. So at the moment, to your point, you're at the early days, and we've already done a lot, but it stands to reason that you have a different business model. You have this credibility issue of the past. There's a little bit of let's wait and see, and rightfully so. But we do believe that we are addressing that, and addressing that very deliberately and head on, because that's the way we want to operate. So it will take a little bit of time. You also see, there's a lack of liquidity from a share price point of view. There's lockups in place. I think that will anyway take a little bit of time. And so probably, we're now in June, and it's the beginning of our first full fiscal in a kind of clean way, if you like. And even in this set of results, I'm talking about this 26-27 first full year, when we go to market, the first half will still compare to the first half of the old Celsey, which again still has a little bit of complexity in for comparative purposes. But I think it's the journey that we're on. We have to be transparent. I've always been that way. I'll take it on the chin, the good and bad. And we think we've done some really great work in positioning a good strategy, and now we have to execute. And so far we are executing, and we need to continue on that journey.
George, I've got to ask you, if you come back after your next set of published results, what would you hope that the market better understands about Celsey by then? Because you have been, I think, very repeatable, very open and transparent, and on a number of platforms, which is hugely refreshing. Regardless of the numbers, what do you hope that the market does better understand about the Celsey business in the next sort of 6 to 12 months?
Yeah, it's a really great question. Because of the debt to equity conversion that we did, I mean, we listed on the 27th of November. My half year was 4 days later. So when we went to market in February, I mean, effectively, we were talking about the old Celsey, and the listing was done on a pro forma basis. So there's still a lot of questions that will come through there. When we go to market, I think it's in August, late August somewhere, for the full year, then I'm hoping that there's a better understanding of what was once off transactions as a result of the listing, because there was some significant debt to equity instrument conversions, etc. And once there's a deep understanding of those once offs, you can give a lot more clarity on how to predict this business going forward. So my hope is that outside of the once-offs, this is now what prepaid base looks like, and the revenue, and with our guidance, postpaid, enterprise, MVNO, so that it's super clear, and then it judges on the numbers and the growth rate relative to the market. So a lot more clarity post the once-off activity, I think, will now come through by the time we go to market in August.
Fantastic. Jorge Mendes, thank you so much for the time to get into some of the weeds around the strategy during a closed period. Always tricky to do, but I think we managed to get to the heart of what the Celsey story and turnaround, and kind of, as you pitch it, the telco of the future really looks like through your lens and the office of the C-suite. George, thanks for your time.
Thank you very much.
Well, that was Jorge Mendes, CEO of Celsey, talking to us in a closed period. Sadly, we couldn't get stuck into some of the more complex numbers. I think the market rating has shared down recently, and clearly it is one of those stories that is going to be More show me than tell me, but with Jorge Mendes at the helm, there does seem to be a renewed energy inside South Africa's third largest telco operator. Well, you've been listening to the Monocle Banking Podcast with me, Michael Avery. Be sure to like, share and subscribe, and join us next week for more insights from the front lines of finance. Take care.